If you look at any price chart, and you will notice that price does not move in a straight line. It does not move up or down vertically. It moves in waves, and these waves are called market swings. In a bull market, price rises with a series of up and downswings. Naturally, the upswings generally exceed the downswings in length. The reverse is true in a bear market. By observing market swings, you will be able to notice the structure of the market and get clues on whether the market will move up or down, and following market swings must be your first step to read the market bias. Another way to look at market swings is to think of them as a higher time frame perspective. Each swing is equivalent to a bar in a higher time frame. This is why some traders use a higher time frame to evaluate market bias. There are two challenges with the higher time frame approach. First, the higher time frame is usually chosen arbitrarily. Common choices are multiples of 3 and 5. This is why some traders use a higher time frame to evaluate market bias. There are two challenges with the higher time frame approach. First, the higher time frame is usually chosen arbitrarily. Common choices are multiples of 3 and 5. For instance, if your trading time frame is 1 minute, using a multiple of 5, you will use the 5-minute chart for determining the market bias. However, there is often no sound basis for the choice of the higher time frame. Next, by using a higher time frame, you must split your attention between two time frames. While some traders might find that manageable, some try to keep trading as simple as possible and focus on one chart only. By analyzing market swings, you will be able to factor in the price action of a higher order into your analysis without a second chart showing a higher time frame. The advantage of this approach is that you will be able to evaluate the ongoing price action within its larger context on the same chart. So, we will focus on reading market swings to deduce the market bias using a single time frame. So how to define market swings? The first step is to classify every price bar into one of the following 4 types: up bars, down bars, inside bars and outside bars. These labels describe the relationship of each bar high-low relative to the previous bar. 1. Up bars have the following characteristics: higher high, higher low compared to the previous bar. 2. Down bars have lower high, lower low compared to the previous bar. 3. Inside bars have lower high, higher low relative to the previous bar. If the high or the low or both are equal to that of the previous bar, it is still considered an inside bar. Bars have lower high, lower low compared to the previous bar. 3. Inside bars have lower high, higher low relative to the previous bar. If the high or the low or both are equal to that of the previous bar, it is still considered an inside bar. 4. Outside bars have higher high, lower low relative to the previous bar. If either the high or the low are equal to that of the previous bar, it is still an outside bar. So, by using this approach, the closing price of a price bar does not matter in the classification. An up bar might close lower than it opened. A down bar might close higher than it opened. For a bar that closes higher, we will use the term bullish bar. For a bar that closes lower, we will use the term bearish bar. Let's identify the candles in this example. We have 4 up bars, followed by an inside bar, another 3 up bars, and another up bar, despite being a red candle, because the high and low were higher relative to previous bar. We then have a down bar, 3 up bars, 2 down bars and an inside bar, up bar, then outside bar. Because the high and the low are equal to that of the previous bar, so it is still an outside bar. Then an up bar, an outside bar, followed by an inside bar, and another inside bar, 2 down bars, 4 up bars, inside bar, down bar, an inside bar, down bar, an inside bar, and finally, an outside bar. With this approach, you don't need to memorize tens of candlestick combinations, you just need this 4 types of candles. I recommend opening a chart and start reading candlesticks until it becomes very easy to determine which type is. Do this until you will be able to recognize the type of the candle almost instantly. Once you have mastered the different bar types, you will be able to identify market swings with ease with these 4 rules. 1. An up bar starts an upswing and confirms the end of a downswing. 2. A down bar starts a downswing and confirms the end of an upswing. 3. Inside bars do not affect the direction of the current swing because they do not break the previous high and low. 4. Outside bars break both the previous high and low, so it introduces uncertainty into the market structure. However, as each swing is a minor trend itself and trends tend to continue, we give the benefit of the doubt to the current swing. Thus, outside bars in an upswing continues the upswing. Similarly, outside bars in a downswing continues the downswing. Now, we took the previous example and we marked out the market swings, base. On the bars that change the direction of the market swings. The circled bars are inside bars and outside bars, and they do not affect the direction of the market swings. So most swings are confirmed by an up bar or a down bar. However, under exceptional circumstances, it is possible for a swing to form without either an up bar or a down bar. An upswing can be formed when the market rises above the last swing high without forming an up bar. Similarly, a downswing can be formed when the market falls below the last swing low without forming a down bar. An outside bar is always involved in such cases. This is example of the market forming a new downswing without a down bar.